Important parties in a project financing. In learning how to implement a project financing, it is important to understand the important parties involved and what their roles are. This section lists some examples of important parties that one would usually come across in a project financing. Construction contractors. These parties are directly responsible for constructing the infrastructure for the mine, delivering the project on time and on budget. In the case of a turnkey contract, the construction contractor project manages all the different aspects of construction up until ramp up to nameplate capacity. This includes the designing of the project, ordering of long lead time items, construction, and training of workforce. The construction contractor can in some instances be a sponsor of the project or a related company in the borrower group. Some projects benefit from a completion guarantee from the construction contractor. Here, the construction contractor would pledge to inject any additional funds into the project to ensure its completion due to unforeseen expenses or budget shortfalls. Lenders would require the benefits of such completion guarantees to be ceded in their favor. This means that in the event of a default by the borrower, the construction contractor's main duty of care is to the lenders. This ensures that the project will be completed irrespective of any troubles the original borrower would encounter. The operator. In some instances, a project company may not have the in-house expertise necessary in order to effectively manage and maintain mining operations. It would then use the services of an operator to ensure that its final sales product was produced in the required quantities and at the desired quality specifications. Operator contracts can either be fixed price, whereby the operator receives a fixed fee for the production of saleable product, and it is therefore in the operator's best interest to maximize efficiency, as any cost savings translate into higher profit for them. Alternatively, operators can also work on a cost plus or fixed margin model, whereby the fee charged to the sponsor would include the cost of extracting and processing ore, replacement capex, and other direct operational expenses, plus an agreed profit margin. This model, however, does not incentivize the operator to aim to maximize efficiency, unless there is the presence of competitor operators that can do the same job or better at lower cost. The operator can also be a related company in the group structure of the borrower. Lenders would require the operator's agreement to be ceded in their favor, allowing them to step into the operating contract on behalf of the borrower in the event of default, and instruct the operator on how to carry out their duties in the best interests of the lenders. Key suppliers. These are companies that supply vital inputs necessary in order for the mine to be able to operate. For example, fuel, electricity, and water. Offtakers. These are the final purchasers of the finished product sold by the mining company. The mining company may also sell its finished product on the open market through exchanges. Independent technical experts. These are subject matter experts in various disciplines associated with a project. Their aim is to independently verify the results of any feasibility studies and to independently verify any construction or production milestones of the borrower during the term of the loan facilities. Development financing institutions and export credit agencies. These are usually governmental or international organizations that have a mandate to promote certain economic activities and foreign direct investment in their signatory countries. For this reason, their investment mandates may differ slightly from those of commercial lenders. They may take positions in the loan facilities that are subordinated to senior debt or that carry a longer tenor than the commercial lenders. Often, they may take positions with some upside sharing mechanisms built in, for example, share warrants. They often provide the benefit of significantly de risking a project politically and also add to its international prestige or sense of importance nationally and globally. Banks. Banks are the most common providers of capital in project financings. Within bank lending consortiums, each bank could be assigned a different role. Some examples include facility agent. The facility agent is responsible for actioning requests and disseminating communication on behalf of lenders to the borrower and vice versa. Usually, the lead bank in a lending consortium would be appointed as facility agent. The facility agent would usually only act upon a majority lender instruction. This typically occurs when lenders holding 66.6 or more percent of the total facilities vote for an action to be taken and instruct the facility agent accordingly. Technical bank. This is the bank in charge of the technical aspects of due diligence and project monitoring. They are usually responsible for agreeing a base case financial model with a borrower, which best reflects key production and financial milestones of the project over the life of the loan. Secondly, verifying that the ongoing project milestones and technical undertakings are achieved. Drawdowns on loans are usually conditional on certain milestones being met before the funders can make funds available. Also, financial covenants will be tested periodically. It is the technical bank's job to work with the borrower to ensure that such tests are carried out accurately and to the satisfaction of all lenders. And thirdly, verifying that the technical due diligence was carried out to the satisfaction of all funders involved. This involves verifying all licenses, reserve statements, and permits. Account bank. This is the bank with which the proceeds account and the disbursement account are held. The proceeds account is the account into which offtakers pay the mine, and the disbursement account is the account into which loan drawdowns are paid. The account bank is usually the MLA or facility agent, but can also be another member of the lending syndicate. Insurers. Lenders may decide to reduce their risk even further by taking out insurance on their loan exposure. In such arrangements, if the project was to fail due to certain events detailed in the insurance policies, the insurance companies would pay the lenders a predetermined sum of money. Usually, insurance policies take the form of political risk insurance, where lenders are covered for discriminatory actions of the governments of the host country of the project. For example, expropriation, changes in legislation, or excessive tax increases which may cause the project to fail. Commercial risk insurance, where market events such as severe commodity price dips, production interruptions due to malfunction, and strikes or failure to secure offtake cause the project to fail. Lenders would also insist that the borrower has its own suitable insurance policies in place covering operational breakdowns on site. Local authorities. These governmental bodies have legal frameworks which project companies would need to operate under in order to maintain their required permits. It is therefore very important to make sure that the project company is always in compliance with environmental, tax, legal, and other frameworks in order to maintain its ongoing operations. Lenders would often draft wording into their loan agreements whereby any breach of such frameworks by the borrower or any material related group companies would constitute an event of default. Timeline for the implementation of a project financing. Due to the complexity of raising a project financing, adequate planning is necessary in order to ensure that all project parties work together cohesively. This timeline illustrates the key work streams necessary in order to execute a project financing. It should be noted that many tasks are usually performed simultaneously. Teamwork is vital to ensure the timely delivery of all information, permits, key contracts, and legal documentation necessary in order to close the funding. It would typically be the responsibility of the mandated lead arranger, MLA, to coordinate all the moving parts of the financing to ensure that the funds are provided on time.